What's up, everybody? Michael Silva here. Look, we have not gotten a reading like this since the great financial crisis. What am I talking about? I'm talking about that number right there, which represents 7% of the stocks in the Nasdaq 100. Only 7 of them are above their 200-day moving average, the Godfather moving average, which, if you know Paul Tudor Jones, he frequently is quoted by saying, nothing good happens under a 200-day moving average. Well, 93% of the stocks in the Nasdaq 100 are below that level. Now, this is where some critical things can take place, where we can see some monster rallies or we can see some breakdowns. So are we going to get a melt up? Are we going to get a meltdown? That's what we're going to talk about in today's Stock Market Brief Show. My name is Michael Silva. I use technical analysis and intermarket analysis to get a good idea as to where the stock market might be headed next. We got a lot to talk about on today's video, so let's just go ahead and get right into it. All right, everybody, welcome back. So I want to first show this tweet here that I pulled from Twitter, and he was showing a very cool analog between 2008 and 2022 of the S&P 500. You can see there's this topping structure, head and shoulders, falling wedge, right? Head and shoulder to a falling wedge, and it just shows what could potentially happen if price action continues to break down. This was the great financial crisis, and you can see right now we are on the brink of a further breakdown. Does that mean we're going to break down and follow this same script? Absolutely not. But what I did find interesting about this analog was comparing it to the first slide of the screen with the Nasdaq 100% of stocks above the 200-day moving average. We're at a very similar type level. Today, a lot of fear in the markets, red across the board. The Dow Jones was down 741 points. Energy was one that I was paying close attention to for a potential move to the upside. It gapped beneath the low, so it already disqualified that, and it fell a total of 5.63%. Meanwhile, oil was rather flat to neutral on the day. You can see defensive stocks did lead the way, if you want to call that leading. We'll put quotes around that. If you take a look at the heat map on the S&P 500, clearly red across the board. Nothing, really too green or anything weird that stands out here. Just very, very bearish activity. Now, what took place to cause this mayhem in the markets? Well, overnight futures session, Switzerland, they got their first interest rate rise, and that was the first in 15 years that came. And you could see that the futures were green earlier on in the trading session overnight, but then just went completely red for a big gap down. If we take a look at the 15-minute time frame on the SPY, you can see that we closed here right after the Fed move. We kind of rallied up, but then this huge gap that took out the entire trading day here and close, you can see it got actually right below the low of the prior trading day. And when that happens, you can typically see some further momentum to the downside. But it was rather a just choppy to sideways day as we go into Opex. One thing that I did notice was the daily VWAP. It tried to recover, but it could not do it. I myself took a trade in IWM earlier on in the day, saw this cool structure, went up a little bit, but then it ended up stopping me out. Did some bottom fishing right there with no luck. If you take a look at the SPY expected move, we're about 2 deviations out from it, which, by the way, we had a 12.55 move today, so $12, $12.50. If you remember a few episodes ago, we talked about how the options market into the Fed meeting was still pricing in about $130 expected move, which is roughly $13 here on the SPY. And as you can see, today we got that type of volatility. Okay, so the options market did tell us about that ahead of time. Now, if we look at the 15-minute time frame, zoomed out a little bit, potential here, right, for a falling wedge. I'm just trying to grasp on any bullish thing that we can see. Keep in mind, the 5-day moving average, it is still declining, which means what? Exactly what we said yesterday, right? If you haven't gone long yet, or you're bullish and you're waiting, we'll continue to be more patient because we still have a declining 5-day moving average. That needs to flatten out, then it needs to get bullish. But I am, from a tactical perspective, looking at these smaller time frames where you get positive divergences. We're outside of the expected move. Perhaps we get a pop back up into that range in the very near future. We haven't even tagged the 5-day moving average for multiple trading days, so that will probably occur here in the very near future. If you take a look at the Qs, that is also trading outside the weekly expected move. Same with the IWM, significant hit to the downside in small caps, down 4.63%. Now, This is where I want to get into the interesting levels, because this is where breakdowns could become very severe, but also we can also get face ripping rallies. Okay, and if you haven't watched this video, which was a few videos ago, I talk about critical levels that I'm looking at to become more bullish. And these critical levels that I discussed also, led to where stock markets can actually crash. And we talked about that. And well, we've been seeing some severe sell side from that area. So watch that video if you haven't watched it. But let's get into some other very critical levels here that I am paying attention to. I want to look up big time charts, yearly time frames, and I'm going to use the same EMA that I like to use on these big time frames, the 5 EMA. Why am I calling this out right now? Well, because the Dow Jones Industrial Average it's down 17.64% on the year. Pretty bearish looking candle if you ask me, and look at where we're coming down to. We're coming down to that 5-period EMA that's at 29,525. That can get pierced, but it can also act as a level of support, which we've seen in prior yearly candles. Okay, so it's not just the Dow Jones Industrial Average, also the S&P 500 is flirting with it as well. There was a low on the year, right? It's down 23% year to date. There was a low of 36.39. Okay, the EMA is at 36.09, so that could potentially act as some sort of level of support, right? With this big, huge move to the downside, and it's halfway through the year almost, and we have another half year remaining. So we could see a bounce, right? This is where bounces can take place, right? But, let's be cautious. We'll look at a couple more. Nasdaq 100 also flirting with the 5 EMA. It pierced beneath it. Now it's pretty much sitting on it. The current close is down 31.82% on the year. The close was at 11,127. The EMA 5 is at 11,162. All right, so it's just slightly there below it. So interesting area to keep an eye on there. And then if you look at the IWM, completely pierced it. It's down almost 26% year to date. So this could be a potential opportunity if you are trying to catch a falling knife, that is. I tried catching one today and it stabbed my hand. Although the risk that I used was relatively very small. Let's continue on here though. Let's look at the SPY on the weekly time frame. This right here was a big gap down, right through the 38.2% retracement level, measuring from the COVID low to the peak in the stock market. And now what I want to call out here to pay attention to is a 20 week moving average, and this right here can potentially act as a level of support, and I'll show you why here momentarily. First and foremost, it's in confluence here. I have a little orange box. This is going up into around the 50% retracement level, so that is a strong possibility that we can get some continued momentum to the downside to around 350. And if we keep continuing to break down, I looked at these other key levels here where there was resistance, where this gap took place, right? That would bring us to the 61.8% retracement level, which is at 313.68. So if there is further downside, start looking at these as potential levels to go long. Now I want to zoom out of this chart to show you why that 200-week moving average could be potentially important. Well, in 2008, right, that's the theme, right? Big financial crisis that took place. What happened when we came down to these levels? Well, we saw some face ripping rallies. Now we're not there yet, right? But if we do go down to that level, it is something to be aware of, because as we've seen price hit it here, then it acted as resistance, but then it started holding as support, almost hit it, and then this quick pierce right through it over here. So it's a key level to basically just keep an eye on. If we do get down to those ranges, it might not be that easy, right? We might pierce through it further, something similar to that. Maybe we might not even reach down to it. That's always a possibility too as well. But that is a very important level to keep continuing to monitor. Now, the Nasdaq 100 is very close to that weekly 200, and it's also right in confluence with the 61.8% retracement level on the weekly time frame, which brings us down to around 10,581 on the Nasdaq. And now that is interesting to me because we're coming into where all this chop was right here too. So there was previous support. We have this, and then we have the 61.8 retracement level. So a lot of confluence of support in this level as we're already down severely. And you remember, right, bear markets, they can have face ripping rallies. So that's what I'm looking for to be cautious of. And I'll wrap this up in the conclusion section, when we get there, of why it's important to know these key levels. If we go further to the downside, right, we're still pretty far off the pre-COVID high. And that's right there below that 10,000 marker, right at around 9,800. So that's also a key level to watch if we had some further downside. Let's continue on and zoom out of what typically happens when you tag that 200 weekly moving average. Well, if you go back in time looking at 2008, very similar story that we talked about in the S&P 500. We tagged that 200 weekly and we had a huge face ripping rally that brought in all kinds of euphoria and excitement. And guess what? It then dumped out and fell hard. Okay, so that level has produced big rallies in the past. It's held as support, it's held as resistance. So we'll see here what that level can do because we're not too far off of it. Now, let's even look at a bigger composite. This is the Wilshire 5000 composite. This is a very good look at the overall markets. Well, look where we tagged. Pretty much spot on, right? To the weekly 200. And that's right there in confluence with the 50% retracement level. And if you just look back also, it's right around all that prior chop that we got, right? That was kind of lined up with the pre-COVID high right there too. So this could very well act as a level to hold where the bulls can try to get a face ripping rally. Sometimes it's not that easy, right? Sometimes we have to go a little bit further down, shake some people out and then move. So that's always a possibility too. But just be mindful that we are getting to these levels as of right now, and the trend is still technically up on these 200 weeklies. Now, if you take a look at the New York Stock Exchange, same thing. We're looking at a broad market. It's pulling down to the 38.2 retracement level. That's also tagging the 200 weekly moving average. Okay, so this is where bulls can really step in and do some work and rip some faces off some bears. The reason why I'm telling you all this really right now is because these levels, despite all the bearishness behavior that's going on in the markets, right, not the greatest area to short into, right, into these areas of confluence. This level also lines up with where? The pre-COVID high. All right, so if we get some further downside, where can we potentially look for a bounce? There is a little air pocket right here that's never been filled. That's right around that 50% retracement level, so we'll keep an eye there too as well. If we continue on the IWM, it's been in a down channel. This down channel has been tagging low, going high, tagging low, going high, tagging low, going high. Now it's tagging low. Is it going to try to get back up to the high level and just continue this downtrend? That's always a possibility. If you take a look at where price action is now, we had a big gap down through the 200 weekly moving average, all right? So that was a pretty powerful move. And where did price come to? Well, it came to fill this gap right here, almost just about filled this gap. And then also it's at prior areas of resistance. So we're coming down into this area that can very well act as support. Now, the reason why I had this 200 weekly here and a couple arrows is I want to show you, we did have that big gap beneath it. And that's kind of reminds me of right here where we saw, okay, that was where some real fear stepped in. All right. And that was the pandemic crash right there. And then when we started recovering over here, right, we had a big weekly move. This was a lot of fear down here. Christmas, this was going the Christmas Eve massacre. And you can see we closed beneath it, but then we saw a big monster rally from that level. Okay. And then it went obviously sideways, went a little higher, and then we just completely nosedived. Now, another reason to be very bullish is Cramer just recently said to hold off on buying stocks until the market slows down. And if you know, inverse Cramer or Mount Inverse over here, you typically do the opposite of what all the talking heads say. Now, that's more of a joke, but also we have CNBC coming out with the Markets in Turmoil episode, and typically when you get these, right, you typically do the opposite of what the crowd is saying. Now, let's keep continuing on here because that is just a sentiment indicator, if you even want to call it that. But the percent of stocks above the 50-day moving average in the S&P 500, it's at 2%. All right, I think it's actually lower than that. I've read somewhere that it is lower than that, like 1.5 or 1.6 or something like that. That means that 98% of the stocks are in the S&P 500 are below their 50-day moving average, and then 13% are above the 200-day. Or another way to say this would be 87 stocks, right, are below the 200-day moving average in the S&P 500, and these are just horrible levels, right? And we've gotten them before and we've seen bounces, but like I pointed out at the beginning of this episode, this hasn't been seen since 2008. And what happened there was we actually had further downside and bottoming out, and then we started picking up. Right here, it looks like it touched it, right? It does look like it got close, but it actually didn't. This one did not get as deep as the 7% reading, but it's darn near close to say the least. All right, let's continue on here. I want to look at the BP charts. BP SPX updated numbers 26.95. All right. And if you take a look here at this reading, this thing is just getting hammered, 12.4, and the RSI is getting overextended to the downside. BP NDX 29.98 is now officially in that oversold condition. But that's crazy to me because this RSI reading is not nearly measuring up to where the reading is on this chart, right? It's at 7% right now. And if you look back through history, we haven't seen that for a very, very long time. I'll have to show a chart here. Dow Jones Industrial BP chart as well. RSI is getting to that overextended territory. And obviously the reading is at 10, which is very low. We do have a positive divergence on the advanced decline line. If you take a look, we have a low and a higher low reading. We have a low and a lower low on the SPY here. And sometimes we can get some bounces with these readings. Just like right here, I was pointing out that we had a negative divergence, right, moving up. And then we started seeing these lower highs right there as we're getting higher highs moving up into that way. So could be something similar, just to be mindful of it. If you take a look at the dollar, got hit very hard today. This is probably the same situation, right? There could be a bunch of different narratives as to why. Could have something to do with what took place with the rate hike in Switzerland. You could see that the S&P 500 did not rally with this dollar drop, but we'll see here if this is all going to change coming after Opex. Remember, we have a 3-day weekend up ahead. Oil also flat on the day as we previously discussed, put in a nice bottoming tail hammer candle, right? Came down, very rough looking trading day, but then recovered a lot of its gains, unlike the energy sector. So we'll continue to just monitor and see what takes place there. Gold's been really choppy, right? This inverse head and shoulder I kind of redrew out. We had a nice big break of it, but then we had this fake out. Now we're starting to see a little bit of a recovery. So we'll continue to see if this wants to perpetuate outside of this trading channel, which it is to the downside. If it starts breaking out to the upside and breaking this inverse head and shoulder, 1980 is the level to watch. TLT, bullish engulfing day. That is bullish. We have a positive divergence here as the price action is going lower, but the trend still, my friend, remains to the downside. So even if we get a pop up, even to 115, that still is lower highs and lower lows. So you got to be patient here with the bond market. And if you look at the VIX and other volatility products, where are we? We close at 32.95. Okay, if you look at, I guess, a 30-minute time frame, pretty bearish looking closing candle, but it's a high reading, and this is where things could get very, very sticky, as we've previously been saying. It's not just that. The RVX is at 38.26. This is high reading, so this is not where you get fancy, right? If we start breaking out of this, contraction pattern right here, we can see a severe move to the upside, and that move can really put a lot of pressure on the IWM small caps, okay? And then VXN2, same thing. We're up at 38.67, almost a 40 handle right now. So this stuff is getting, obviously, and continuing to be very dangerous in the markets. Now, I want to talk about going into tomorrow, right? It's Opex, but what I want to call out here is the big names, right? First and foremost, the index products were outside of those weekly expected moves. However, if you look at these big products, we're right there on the lower expected move. So I don't know if I expect much more downside come tomorrow. I wouldn't be surprised to actually see some sort of rally to suck people in. I'm not going to be placing any bets going into tomorrow, most likely, because I want to get through Opex. I want to get through the weekend, and then I want to see what the market wants to do as far as digesting this big week that we just had. But take a look at Apple. It's floating right there at its lower expected move, okay, for the week. And this was given to us last Friday. Microsoft right there at the lower range. Google, another big one. We basically closed right on the lower risk range. You can see Amazon, it's been basically tagging it and doodling around all week long right there at the lower risk range. And then Tesla too as well, right there at that lower risk range, okay? So we're already down there. Is it going to break down and see some further selling? I don't have that answer. What I can tell you is that would just be, a continuation of a trend that has been putting in lower highs and lower lows, okay? And it could be potentially a dead cat bounce, right? There's all kinds of different variables that we can work through here. The reason why I'm showing and telling all these key levels is, one, Okay, so we'll kind of wrap it up before we get into crypto. The big thing here is this is not the place to all of a sudden initiate shorts. We saw a big move down today, and people might be like, "Oh no, it's gonna crash further. It's gonna crash further." It might, but this is still not the area from a risk to reward standpoint that you want to short. Why? Because we're coming into major areas of support, or areas that can act as support that can cause a face-ripping rally. So, you know, if you're not familiar with how to short, I'd be very cautious with that. If you want to start looking for longs, okay, but you need to be tactical and you really need to manage that risk because it's not going to be easy. Overall, when I'm looking at this market right now, one of the hardest things for people to do in times like this is to sit on their hands and be patient and do research and start looking at various stocks, see what's setting up, see how price action is acting, because as it stands right now, it is very, very complicated market environment to be a part of. We have one person on the very far left that's super confident it's going to melt up. We have other people on the right that's going to crash down below zero. That is just what's taking place in these markets. There's no clear, concise view other than what the price chart is telling us on these index products. And the price chart is telling us right now we are still in a downtrend. All right, we're in a downtrend, but we're moving in to, as we already stated, some key levels of support that we need to be mindful of. All right, so let's hop into crypto real quickly. All right, crypto, Saylor to Schiff tool is still obviously, oops, what just happened there? Saylor to Schiff tool is still pointing straight down. We wiped away that bottoming tail, but that can still come back, right? We kind of discussed that on the Ethereum page on yesterday's video, that it might come down a little bit, and then we'll see if it forms another one. But that was a nasty, nasty trading day there for Bitcoin. And then Ethereum, same exact situation. So once again, trend remains down. So don't fight the trend if you're not familiar with being tactical. Be careful in this environment and hope those levels help you out. See ya.